Good afternoon, everybody. I don't know where my screen went to. Well, that's very interesting. Everything sort of disappeared. Oh, I got kicked out of the room. Test. Hello, I hope you can, let me just get everything. I'm hoping you can hear me. Anybody in, yeah, we got a few people in the room, and maybe let me know. I got kicked out of the room just as I went live, which was really interesting. And so I'm just trying to get everything set back up again. Let me just go over here to my application window. All right. So good afternoon. If you can hear me, would love to hear from you. There's Carlos, Kyle, Stewart, sound but no picture. Oh, there should be a picture. You still have picture now. Okay, good. Have picture now. Great. So here I am. It's Peter Temple, and this has been a long time coming, actually, that I put together a program on Elliott Wave itself and just the basics. And I will warn you now, I'm not sure that I can keep this to an hour. We'll just have to see how it goes, because Elliott Wave is really quite complicated. I'm just going to start you off with a little poll. The people that I've got here, I don't have that many, which is probably a good thing. I don't have a poll. All my polls when I got kicked out disappeared. So we'll just do it by ear. But maybe you can tell me how many of you are absolutely brand new to Elliott Wave. You might have a little thing there. No, I don't see one. Can you let me know how many people are absolutely brand new? Just kind of write in your chat box there. Like if you're brand new, let me know. We used to have, they keep changing this program on me all the time, and we used to have a little hand thing. If you have the hand thing, you can just put up your hand by clicking on the hand thingy at the bottom there, and that will give me a good idea. And if not, we'll just move on. I'm not seeing anybody. You can, good sound and a picture in tropics. So anybody tell me if they are brand new to this. You can just put up your hand. There's a little hand thing at the bottom. Or did they change that on me? No, I think that should be okay. And then I'll go from there. Well, I'm not seeing anything, so let's just move on and we'll get into this. And then I've got a couple of little things I can share with you at the end. I want to try and have enough time that I can get you any questions that you have, that I can answer those. And that's really one of the key things. But I've got a lot to get through. What I'm going to do is just try and give you the basics of Elliott Wave so that you get a good understanding of what it is all about. And from that, maybe you can do some further research. If you have done any work at all in Elliott Wave, you probably have the Elliott Wave Principle, which is the key book, and you can see it over here. That's the one written by Robert Prechter with A.J. Frost, and it was written, I think in the 70s, and they've done a number of updates. And if you have read that, you're going to get a good idea of the Elliott Wave Principle. But there are errors in the book, and I've highlighted a lot of those. And I'm working on a book, and I'm also working on a course. But this book is good enough that it will give you a really good idea of the Elliott Wave Principle, and then it's really kind of putting it into practice. And the errors aren't large enough that it is going to deter you that much. But if you were doing analysis, you really need to know what the errors are, and then some of the new information that I've got out there, for example, and some of the things that are wrong. Elliott was alive in the 30s and 40s and 50s and wrote the Elliott Wave Principle book. He had a couple of them, and also wrote one on nature's laws. And all of those, and I'm going to allude to some of those as we go on here. It's a great, if you're really interested in Elliott Wave, this is a good book to get, and you can search Elliott's Masterworks, and I think you can probably get it through Amazon. But that's those two books are really good, this being the key one. So let me just start by getting into an overview of Elliott Wave, the way that I look at it, and some of the key concepts. I'm going to do key concepts first, and let me just give you an idea of where I'm going. Then I'm going to talk to you about 5-wave trends, because 5-wave trends is really the core of Elliott Wave, and it's also the core of the market. So Elliott Wave is really how the market moves. And I think of it very much as a science. And the key thing you need to keep in mind is that it's the analyst that screws up and does a terrible job with Elliott Wave. It's not that Elliott Wave is broken. You get an awful lot of very strange things happening, and configurations and labeling that people don't do properly. And so that gives them wrong counts. And I'm going to show you some examples of that a little bit later on. Then I'm going to get into some motive and impulsive waves and explain those. I'm not going to get into a lot of detail on the corrective patterns. I'm going to tell you what they are, but that's some research you can do on your own. That tends to get pretty complicated. Then I'm going to give some examples of some waves, and unfortunately I had some polls to give you that you could answer, but we'll see how that goes. I'll see what you think of some of these things. And then I'm going to talk a little bit about B-wave tops, B-wave tops, irregular tops, which is something that is a little bit contentious, and I'm going to kind of look at the current count that we've got in the U.S. indices right now, and in particular in the S&P 500, and then I'll just give you a little summary at the end. I think that gives you an idea of where I'm going. So an introduction to Elliott Wave, where I want to start is that markets are based on the mood of the herd, and I talk about the market as being a mathematical representation of the mood of the herd. And otherwise, looking at the market will tell you how people are feeling. Either they're very positive or they're very negative. And one of the next things that is key to that and falls in with it is events do not change the direction of a trend. Now, I got into Elliott Wave in about 2005, I think it was. It might have been a year or two earlier. And we all go through a lot of things when we first get into the market. I mean, I used to get up in the morning and look at the news and figure out what events were happening, and then I would go chase stocks and do that sort of thing, which proved to be absolutely crazy, because when you get into this more and more, you realize that events do not change the trend. They have an effect for a day, but they really don't change the trend, and the trend just keeps on going. They will react to the trend maybe during that one-day period, and then I'll turn around and follow it again. And so you learn over time that events do not change what the market is doing. It's really the other way around. Depending on where the market is, will tell you whether the mood is very positive, and they tend to do things based on where the market is, whether they have a positive mood or a negative mood. And one of the things you can tell now, for example, about the mood, this gets into cycles a little bit, is we have an awful lot of negativity now because the market is turning down, and you're going to see that all over the place. It's also the top of a very large 1,000-year cycle, and things are going to stay negative for a very long time, as of course this market crashes, and it's going to get an awful lot worse. So that's one of the things that looking at the market will tell you whether people are negative or positive. Elliott Wave is all about pattern recognition and probability. So one of the things I learned when I was younger, my father put me through a battery of tests when I was about 18, and I think he thought I was going nuts. He wanted me to be a doctor and or a lawyer. You know, the British, he came from England, and I didn't want to do that, and so he put me through a battery of tests. One of the things that I took was a test on manipulating three-dimensional objects in space, mentally. And that's when you get these little diagrams with five little visual figures in a row, and you have to decide which is the next one in the lineup. They have little circles and things with elements in it, and they change in four of them, and then you have to figure out what the next fifth one was. Well, I went right off the chart on that. And that told me that I could see patterns and was very visually oriented. If you are visually oriented, you'll be very good with Elliott Wave. If you're not, and a lot of people aren't, then it's going to be a challenge. You need to be able to recognize patterns, and you need to be able to look at the screen and see them very quickly and be able to judge what they are. And because really, Elliott Wave is not predictive on its own. But if you understand the wave structures and you understand the corrective patterns and know the probability of what will show up next, then it's predictive, because you can use what you know to predict where the market is going next. And one of the things that we keep saying about Elliott Wave is it's all about probabilities, because there could be 3 patterns that it could go into, but one of them is more probable than the other 2. And so you can say, well, I think it's going to do this. Or you can see the beginning of a pattern and recognize the pattern very early, and then you can trade that pattern based on your understanding and recognition of it and memory of what the pattern is like, because these patterns happen over and over and over again. Elliott Wave is fractal, or the market really is fractal, so it has waves within waves. I'm going to get to that very shortly. And there's 2 types of waves, of course, motive and corrective waves. And motive moves with the trend, and corrective waves move against the trend. Corrective waves are always in 3 waves overall, and motive waves are in 5 waves, and that's one of the key differences. The Fibonacci ratio is in everything. Fibonacci, and if you don't know about Fibonacci, you need to know about Fibonacci if you're in the market at all, because any wave in the market has got a relationship with the with Fibonacci, either 0.618 or 0.382. Those are the Fibonacci ratios. Sort of 62% is the way we say it, very simply. And so you're going to see how that plays in coming up here in a couple of slides. And the interesting thing, it helps you understand, Elliott Wave helps you understand the power of the universe, because once you get into this and you realize that waves always travel in the same patterns, the corrective patterns are always the same. They happen over and over and over again. And they also move very definitively to Fibonacci ratios. I mean, certain waves are always the same length. And you realize that that obviously can't be people reacting on their own to the market, because people are not like that internationally all over the world. So you start to understand that because of Fibonacci, what's one of the clues, that we're really all influenced by electromagnetic waves. And you can see that when you look at the moon, and you have days when the market goes up with the moon, and when you have a full moon, that sort of thing, and realize that we're all influenced by what goes on in the universe. So it helps you understand the power of the universe and the power of nature, and what's happening around you today, for example, with this pandemic and the markets coming down. All of this is very predictable, and was predicted 100 years ago, for example, by a gentleman called Dr. Wheeler, who, and it just recycles around. So Elliott Wave really falls into that same pattern. It's really price cycles. Going over to the next one, 5-wave patterns, 1, 2, 3, 4, 5. 5-wave patterns predict most trend. I'm going to leave this for a moment and get into this in a little bit later. But 5-wave patterns, when you see one, it predicts that there's going to be another one following it. In most cases, there's going to be another wave after a correction. So that's one of the things you can see. They're also 5-wave patterns also begin most trend changes when you have a trend change, and they all end trends. So a trend will end in 5 waves. So 5 waves are very important. And there's 2 types of 5-wave patterns, and I'm going to talk about those as we go through this. That is not explained in the book. In fact, Prechter writes about there being only one 5-wave pattern. Well, no, there are 2 types of 5-wave patterns, and so I'll talk about that going forward. 3-wave patterns always completely retrace. So when you see 3 waves, you know it's going to completely retrace. And you have to account for, this is really critical, because I see this in a lot of the charts that some analysts put out there. I don't look at a lot of charts because one of the things is you have to stay very objective, and when you're doing your analysis, when you're working with Elliott Wave, and really concentrate on the wave structures. But you have to account for every wave in the pattern. I'm going to show you some examples later on during the program where you've got people that supposedly know what they're doing that just kind of pick and choose the different waves that they want to label, and you can't do that. You have to, if you don't label them, you have to at least account for them in your analysis. You can't just decide that there's going to be 5 waves because you see 7 waves there, but 5 of them look really good, and you decide that you're just going to ignore the other 2. That gives you a wrong count. Simple 5s are the other kinds of waves, and I'm going to talk about that going forward. I mentioned there are errors in Prechter's book, and Prechter's got, I know the Elliott Wave International has got a come on their site, a little promotion saying anybody can learn Elliott Wave. Well, anybody can, but to use it for analysis, it took me 5 to 6 years, and I'll bet you half of that was just the understanding that it actually worked. Because, you have to, when you get into something like this, and there's an awful lot of skepticism about Elliott Wave, I had to really see it work again and again and again in order to feel really comfortable that, yeah, this is a science and it works. The other thing was I found the errors in the book and realized that there's some things that were just wrong in the book. And if you follow those errors, you were going to lose money in the market. So it's important to know that, but it takes years to master. If you just want to learn it so that you can make a judgment after, based on the analysis or analyst you're working with, whether they're correct or not, that would be a good thing. If you want to look at the overall market on a daily basis and understand, where it's going, that's a good thing. But when you get into sort of hourly charts and 5-minute charts and those things, you can make an awful lot of mistakes with Elliott Wave if you really don't know it well. It's taken me years to really it took me about 6 years to become proficient at it. And I've been doing this professionally for about 5 years now. And I'll tell you, the first year was a little sketchy, but I work at this 10 to 12 hours a day, and I've spent 20,000 hours at least in the market, if not more. And you just get better as time goes on because you learn from every mistake that you make along the way, and you just get better and better. So I don't make that many anymore. Here is I want to just explain trends. This is a chart of smoking and how smoking from about 1900, when people started smoking, you had actually a 5-wave pattern, which was the trend. And you can see this through virtually any trend that happens in society is in 5 waves. And here you can see the 1, 2, and then the 3rd wave. You can actually see the 5 waves here, a 3rd wave and a 4th wave and a 5th wave. And after we had 5 waves up, the trend turns in the opposite direction. And that was about 1960 or so, a little bit in the 60s, it started to trend and go in the opposite direction. The trend finished and it started to go in the opposite direction. So you'll see this kind of thing all through the market. And if you have a business, for example, some of these charts, you don't need to see. I just want to show you the trend. Carlos makes a good thing. So full screen view makes, I can't do a full screen view, by the way, because if I do that, it doesn't let me see the chat screen or anything else. So I have a problem with doing that. And I have to do it this way. So if that's what you're referring to, Carlos, yeah, that's a little bit of a challenge. But most of the stuff I've got on here, I think it's going to be fine for you to see. Anyway, this is 5 waves up. And you can see that it ended with after the 5th wave. Here's some other ones that I showed recently. For example, this is the number of new cases in the coronavirus. And you can see that it also went up in 5 waves. And people were talking about a second wave. And I said, well, it's already done 5 waves. There is no second wave. It's going to come right back down to nothing. And you can see that in all of the charts. So understanding trends and how they move and that they're in 5 waves will help you with where you are. If you get another pandemic, you would know that, okay, we're probably in the 3rd wave, and then we get a 4th and a 5th. So this, you could even see the 5 waves within the 3rd a little 1, 2, 3, 4, 5, and then we were done. So going over here, here's another one, same thing, 1, 2, 3, 4, 5. This was Washington State, and it showed you the virus going up, and this was deaths, or I think, I don't know, illnesses, date of illness. I guess these were cases. Yeah, confirmed cases. So you can do this with the deaths as well. So I did charts with deaths and cases, and so that's what they all look like. So let's get into talking about Elliott Wave and this 5-wave pattern. So Elliott Wave is fractal. I mentioned that. So this is looking at a trend, a bullish trend, 1, 2, 3, 4, 5. And in Elliott Wave, when you have a trending wave, which is a motive or impulsive wave, we call it, then you will have 5 waves within the first wave, 5 waves within the third wave, and 5 waves within the fifth wave. The corrective waves, the second and the fourth wave, are always in 3 waves. All right. You can see that once you get the 3 waves, they completely retrace. So this is a full pattern. And then once you get to the top of the 5th wave, you're going to get a correction. And this is showing that actually you're going to get an ABC wave of some kind. This is showing what I would call a zigzag here, but it's a corrective wave because you've got 5 waves and 5 waves in a zigzag, but the entire zigzag is an ABC. It's in 3 waves. So all of these are in 3 waves down here, like the second wave and the fourth wave. And these are the motive waves, 1, 3, and 5 to the upside. And it's always like that. That is a typical, and that's really the core of the market, and Elliott Wave is a 5-wave trend, and each one of the fourth and the second have got 3-wave reversions, if you want. Here's another look at it where you can see that even within those waves, you can have another set of 5 waves, okay, certainly in a trending wave. So that is a way that you can tell if you've got a trend and always know where you are. It's also one of the, we're going to get into the rules on a trend shortly. And one of the keys to call it a motive wave is that the first wave has to have 5 waves. The third wave has to have 5 waves within it. And the 5th wave has to have 5 waves within it. The fourth and the second will kind of take care of themselves, but I'm going to get into how those things work coming up next. The other thing is that this is an impulsive wave, so this is the same thing, is that the waves have to have a certain look to them. I'm going to get into that a little bit later, but this is looking at what a bull market wave looks like in reality. So you have a first wave up, second wave down in 3 waves, then you have a long third wave, and the third wave is always the most powerful. It can never be the shortest wave in a sequence. So there are certain rules down here, and I'll go through each one of these. But you can see this is got 5 waves, 3 waves down, another 5 waves, 3 waves down, and another 5 waves. This is what it looks like, and it's very important that the fourth wave have the same gravitas, if you want, or it needs to be relates to the second wave in terms of its size. Usually the fourth wave is a little larger than the second wave, but it can't be a great big fourth wave and then a very small fifth wave. It needs to be an impulsive motive looking wave. It needs to look like this. And this is it on the downside, of course, in a bear market. So the rules for an impulsive wave, or waves 1, 3, and 5, must subdivide into 5 waves, which I've shown you. So here's 1, 5 waves, 3 is in 5 waves, and 5 is in 5 waves. So to be impulsive, that is a rule that cannot be broken. Wave 3 is never the shortest wave. All right, so that's one of the ways that you can tell if something is corrective or not. If you think it's an impulsive wave and all of a sudden wave 3 is the shortest, you know that it's not. It's a corrective wave. Wave 4 cannot move into the area of wave 1. This is probably the most important rule, I think. So 4 cannot extend down to be in the area of 1. So if you see a great big fourth wave come down here into the area, so it just intersects with this first wave, then that whole wave instantly becomes corrective. All right, and it is not impulsive. So that's one of the keys that you need to keep in mind. And then wave 2 always subdivides into 3 waves, and it can be a zigzag flat or a combination. And those are really the keys. You don't typically find a triangle. Well, you never really do. I've seen one maybe once, and it usually is in a combination. So there are certain patterns that are corrective that are only in a second wave. A fourth wave usually has just about anything in it. It's kind of a garbage wave. They throw everything in here, and very often it's a combination. If they're very large, it'll have a combination of patterns. But wave 4 always subdivides into a zigzag, a flat, a triangle, or a combination. Okay, so those are the things in there. Wave 5 can be an ending diagonal. So that's one of the things to keep in mind about wave 5. There are things that can be a little different in it. All right, I'm going to just look before I get into this and just see if there are, let me give you this first. So here's a real motive wave actually in a corrective market. And I hope you can see this okay. But this is actually a wave that we're in today. We're right at the top of it. And I just thought I would grab this. It's in a corrective market, which we're in right now. This is a great big correction that we have. And you can see that this has got in the black, 1, 2, 3, 4, 5. 5 waves here, 5 waves here. And this one actually has 3 waves. This is my first wave. But what you do with that, when you see that, in a lot of cases, that can be a 3. This is one of the interesting things about Elliott wave. The first wave really sets up the rest of the wave. And if you get one of these 3s, there's a little bit of a dilemma as to what is it. Is it a 1, 2, 1, 2 arrangement? If you see this, and it looks like a 3 and it's not a 5, it will typically mean that you're going to have another 4th and 5th at the end. So you can see that I got 5 waves within this wave up to here. And then today we got another 4th wave down, and that relates to this 1, 2, 1, 2 arrangement. It's the first wave giving us another 4th and a 5th. So that's why I made these in red, so that you can see there's 5 waves within, call it the third wave. And then we've got another 1, 2, 3, 4, 5. So there's some complications in Elliott wave that you learn over time. And that's one of the challenges with actually learning it. It just takes a long time to be able to contend with this, because this can be the difference between making a good trade or a bad trade. And I just thought I would point that out. And then before I get into this, are there any questions? The pointer does not work. Oh, that's interesting. So let me turn something on then, if the pointer doesn't work, and I'm going to use this, my whiteboard. Oh, good, they've changed that on me as well. We'll just take this down. So can you, and I'm going to have some problems probably with this. It's not working all that well. So I may not be able to give you, maybe I can just use, I'm sorry that I'm not probably going to be able to, can you see that on the, I think you can probably see that, like a big circle on the 5, can you see that? And on the 2 now, and if that works, then we'll use the old pointer, and that may help me. Yes, okay, so let me just go back, see if there's anything. That one was okay, this one was okay. So I kind of talked about these waves. I think you probably got that, but we'll move forward. Okay, so here's the one. I'll just go over this quickly again, in that you've got on this wave here, this is a motive wave, and I know it's a little bit difficult to see because of the size, but this is a first wave and then a second wave here, and a third wave and a fourth wave, and then we have the 5th wave. So I mentioned that there are 5 waves here. You can see that in the third wave. There are another 5 waves here in the 5th wave, but down here in this first wave, we actually ended up with a 3. And in Elliott wave, you have to make the decision as to, okay, is that a corrective wave, or is it we call it a 1, 2, sorry, I guess that's a 1, 2, 1, 2 arrangement, which ends up giving you an extra 3 and a 4 and a 5. So I've put those in red. So you've actually got the 5 waves here. Okay. And there, and you can include that one within it. And then there's another 1 in red, 2, and a 3 and a 4 and a 5. So what that 1, 2, 1, 2 tells you is that there's going, once you finish 5 waves, there's going to be another 3, 4, 5 at the top. And you need to be ready for that. So that's one of the big challenges in Elliott Wave. The first wave always sets up the rest of the wave because you get measurements off that first wave, and that will give you the measurements for all of the other waves, so you kind of know how long they are. I'm going to get into that next. But this is a good place to ask for any questions that you have. And hopefully this is going to work for you in terms of my pointer now working. So what else did I see here? Any questions on anything I've presented so far? While I'm going on to the next section, I can go back and explain something in a little more detail. I'm going to get into Fibonacci next and how that works in a 5-wave sequence. And that's kind of key to being able to use Elliott Wave effectively, because and actually use any patterns in the market, because waves always have Fibonacci relationships. So I'm not seeing any questions, so we'll move on. Because I got a lot to cover here. So here is a 5-wave pattern here. 1, 2, 3, 4, 5. That's the one I'm looking at. And this we would call an impulsive or a motive wave. Okay, it's just what I showed you on the other page. There's nothing different about it. But this gets into measurements. In a bull market or a bear market, they're exactly the same. You always start with the first wave and you measure the first wave. And there's most programs that you use for the market have a Fibonacci tool, which has they have a number of different ratios. They have 23%, which you rarely use. They have 38%, and that's the same thing as 62 on the other side. So you actually have a tool that looks something like this, where you'll have 23%, you will have 38%, you will have 50%, which you can use sometimes but rarely, and you will have 62%, and then of course 100%, and there's also a 76% in there. But the key ones are 62% and 38%, all right? And I'm going to explain how those work here. Those are the 2 Fibonacci levels that you need to pay attention to. So once you have the first wave measured, that becomes a unit of 1. Okay, and that's the way you consider it. And then you take your Fibonacci tool and you put it at the bottom of your second wave, which retraces always 62%. Well, it retraces around 62%, but it needs to get to 62% in a motive wave. All right, so it needs to be in 3 waves and come down to 62%. That happens to be the preferred entry in Elliott Wave. And what you do with Elliott Wave, once you get 5 waves up, it's a terrible 5 waves, and 3 waves down, then you can look for the 62% retrace level, and that's where you want to get in. Now, the key thing about that is you're not picking bottoms, which are down here, because bottoms can go on you forever. They can turn around on you. You're picking a second wave, and your stop goes at the bottom. So you'll have less risk that way, and it's also turning up into a third wave, which is the most powerful wave of all of them. So it gets you right into the action and lowers your risk. So that's why the first and second wave are so important. But the first wave also gives you the length of the other waves. So once you have that as a 1, 1, which I mentioned to you, then you can measure from the bottom of the second wave, and your third wave will either be 1.618 times the first wave, or it will extend and be 2.618. And a lot of the waves we've had in the market now are this extended. The one that we had that I showed you back here, where was it? where did I put it? Here was actually these waves, because it's the last wave, they don't measure quite exactly, but this third wave ended up being just about 1.618, the length of this wave, and this wave up here ended up being 1.618. So you had these two waves are actually equal length, and then you know when to get out of a wave, because or when you're going to go into a correction. So that's the key thing. And this in a mode of waves, let me get back to my, where have I got? Mode of waves, these are so accurate. One of the problems with corrective waves, and we've been in a corrective wave now for the last 5 months, is you have various Fibonacci lengths that waves can go to. But in a bull market or a bear market where you have impulsive waves, these things hit these levels very accurately. So either 1.618 or 2.618, and then you will have a retrace of 38% in your fourth wave. And then your final wave is typically 1.618 times the first wave again. But it can also extend and be 2.618, but not all that often. Okay, we have had it on occasion. And then once you get to the top of the fifth wave, then everything turns in the other direction. And usually you get a retrace to your previous fourth wave, which is right there, which would be 38% of this entire length up. So once you learn these ratios and you understand how these waves move, unfortunately, these motive waves, we've had a lot of them recently within our corrective environment, but they, to get real motive waves, because we're actually in a counter trend market, they're not all that common. And you need to be careful. Once you're in a set of them, they run in threes. So because it's fractal. So this wave will have a retrace in a second wave because it's fractal, and that will be your second wave. Actually, let me just go back. If it's a second wave, it will come back down to 62%. Then you will get a longer third wave. The third wave will be 1.618 or 2.618 times this wave. All right. And so it progresses that way. So once you have this first wave, you get a good idea of where all the other waves are going in a set of motive waves. All right. Not in a corrective market that we had, but in an actual motive impulsive market. In a corrective market, it does the same thing to a certain degree, but sometimes the wave levels are not that accurate and they can have interesting patterns. That are not as easy to see in a corrective market. So there are real differences between corrective and motive markets. So Mark has got a question. How high can the B wave go? Can it go past the previous motive wave? The B wave, okay, you might have to clarify that, because if you're talking about, I think you're talking about one of these corrections. So being a B wave, where's my other chart here? Where's my waves in three? So a B wave would actually be, in this chart, would be that. So I don't know if you're talking about like a second wave and this whole wave itself, but this is an A, B, C wave. So that's where I'm confused against. Can it go past the previous motive wave? Well, in second waves, cannot go past the bottom. Because then it would not be a second wave. It would be the start of another wave. So that's one of these stipulations about second waves. Fourth waves, of course, can't go into the area of the first wave, or the whole wave doesn't become motive. So usually I say when it goes past the 76% level, like if you're measuring 62%, once it goes past 76%, it's most likely going to a new low. Okay, so you can actually shorten your stop and put it at the 76% level, knowing that, 95% of the time, if it goes past 76, it's going to a new low. So you lower your risk that way. And so did I answer your question? Are we in a B wave now? I don't know what level you're talking about, Mark. You're going to have to be more specific about that and what chart, what asset you're talking about. So if you're talking about since 2009, yes, we are in a B wave. but I don't know otherwise what you're talking about there. So if you can be more specific, I'll answer your question. Okay, so that is looking at the wave structure here on an impulsive wave and one going to the downside and how they retrace. Okay, and these are, you know, I think in my book that I'm writing, I may end up making these a rule, because in a motive wave, I just don't see these things not retracing 38%. And if anybody here has been with me for very long, you know that sometimes I have in the past been waiting for something to hit 62% before I know it's going to go into the third wave. It has to get there. That's only in a motive, impulsive set of waves, not in a corrective market. Corrective markets don't necessarily have to hit the 62%. The March, back to Mark. Good old Mark. The March low was the bottom of a wave, correct? Oh, okay. Well, I'm going to get into that later. Save those thoughts, because I'm going to show you the current pattern and where we are. All right. Here's a little slide just talking about 66.618 and 382. So these are reciprocals. These are the Fibonacci ratios that we use in the market, and add them together, they end up being 1. So that's, you know, the retrace of the I have to remember them over here. I got to get a different color, don't I? Where's my colors? I don't. Oh, here's my colors. Let's just do this. Kyle likes that. Okay, so here's 618, 382, and add them up and they're 1. All right, so those are the two key ones. If you were to look at the planets in our solar system, the ratio between the lengths of the patterns of all of them, if you average them out, becomes 1.618, becomes the Fibonacci ratio. And so when you have this ratio over and over again in the market, it doesn't take you very long to think, okay, we're influenced by the planets. And the only thing it can really be is electromagnetic waves. So I'll let that one seep in for a while. But it's given me, normally you get people that get involved or progress into cycles, which I'm spent a lot of time with cycles as well, more time than I care to talk about. But a lot of people get into cycles through the market. They become Elliott Wave people, they follow Elliott Wave, and the next thing is to realize that, okay, this thing happening over and over again and having Fibonacci throughout it with this number tells you that there's more here going on than just people being in the market. So it's kind of really interesting to take this to the next level. All right, progressing on. These motive waves that I just showed you have to have the right look to them. So you can look at, I've just put 3 different waves here so that you can see how they move. This is in a bull market. There's a first wave here, of course, and a second wave, 3, 4, 5. This one is okay. This looks correct. This one over here is not. And what's the reason for that? Anybody know the reason that this one's not correct? The key reason? Anybody want to weigh in on that? I'll let you think about it. This one as well is not a set of motive waves. And again, if anybody wants to weigh in on why you think this is incorrect, you can let me know. But the look of it is really important. So you need to be able to see patterns. You can measure them, but you need to be able to see when a pattern is incorrect and really doesn't make any sense. Yes, correct. Carlos got that. Wave 2 did not come down 62%. In fact, it hardly came down at all. All right. So this would have had to come down in here to 62%. I'm going to go back to my black because most of this is black and it shows up a little bit more. So yeah, so this would have to come down to 62% down here for that to be correct. Waves 2 and 4 need to look, on BART on the other one. So you got 5 waves here. That is correct on this one. Then 3 waves down. And this one, there's 2 things here. This one is 3 waves. The third wave absolutely has to have 5 waves within it. This does not. The other thing is this fourth wave is huge compared to the second wave. And so you look at this and you kind of squint your eyes and you go, this is an A, B, C. So there's your A, B, C, B. It's hard to draw with your mouse. So you can look at that and go, okay, that just doesn't look right. I don't think the fourth came within, no, fourth is not within the first wave, but it is just the size of this. You look at it and you go, okay, it just looks like a 3. And so that's what it is. So it's really important that it look like this. And in the other, the other direction, it really needs to look like that if it's an impulsive wave. Okay. And that's one of the key things and one of the things you have to get used to over time. So motive waves I've talked about, this gets into some patterns. And one of the things that Prechter decided to do was under motive waves, he listed ending diagonals. At the top of these waves, in a fifth wave can be replaced by an ending diagonal. And an ending diagonal, if you look at it, it really is a corrective wave because an ending diagonal kind of goes like that. Okay, the waves overlap. So your fourth wave overlaps with your second wave. And that's one of the key things with an ending diagonal. He put that under motive waves. In my book that I'm writing, I'm going to suggest that that is a corrective wave that ends up at the end of a wave and tells you that the market is going to turn in the other direction. An ending diagonal here is an ending wave. And right after you see the fifth wave in it, it heads down again, and it heads down quite dramatically. And it always reverts back to the previous fourth wave just below your ending diagonal. Or in the case of a bear market, it will revert back up to this fourth wave, and that will be your first wave. And then you'll get a second wave, and then it will head down. So it's really important to understand these things. These are also one of the last patterns that you call, if there's any way you can sort of save the 5 waves, you do it or come up with some other pattern. But these things, in our market right now, I'm seeing a lot of ending diagonals in the market, but normally they're relatively rare. But you can look at this and say, this is really a corrective wave. It's got the 5, if they're all in 3 waves, that's one of the keys. And so if you get a pattern like this as the ending pattern in a motive set of waves, in the 5th wave, they can also be at the top of the 3rd wave. All right. And I think I've got a chart that sort of shows that coming up sometime soon. Yeah, I'm going to show that coming up sometime soon. But here's your ending diagonal, and you can find them at the end of C waves. You can find it at the end of the 5th wave and at the end of the 3rd wave. All right. And that's about as much as I'm going to say about that. Maybe one other thing is that once you get the trend lines in place, these things can either, the last 5th wave can hit the trend line or go above it. And we call that a throw over, and then it will turn down dramatically after that. The other thing that's really important about ending diagonals is the 5th wave can't be longer than the 3rd wave. So you can measure the length of this 3rd wave and know that, and it caps the market, and know that if it goes beyond it, then it's not an ending diagonal, one thing. But if it hits that level, and it can turn before it, but typically if you get a throw over, they usually go to full length. And that tells you where your entry is if you wanted to pick a top. But once you see it come down, another good entry is to get in right as it passes through the lower trend line of the ending diagonal, and the reverse in a bear market, of course, as it passes through here. So I'll just say that about it. I don't want to get into these in any great depths, or we'll be here for 4 hours. But that is the ending diagonal. There's another one called an ending expanding diagonal that is the same thing, but it has trend lines that diverge. Is that right? Yeah. So the normal ending diagonal, the trend lines have to converge. They cannot be parallel. Okay, so that's one of the other things. If you get a wave that comes down and it ends up being a parallel trend line to this one, you don't have an ending diagonal. Or if it comes down so that it is just beyond the parallel, then that ending diagonal has broken and it's not an ending diagonal. In this one, This has trend lines that diverge, okay? And that's the way you can tell it. I'm not going to get into, these are rare. We actually had one in the set of waves that came down from February. And I know Bart's here. Bart will remember that, where we actually had an ending diagonal, and then it was followed by an ending expanding diagonal. And it was a bear market. So it was really quite extraordinary. I've never seen that before. So, you know, you're always learning new things in the market. And I think I've just about seen everything in Elliott Wave. And then all of a sudden something else is going to crop up. And I'll go, oh, didn't know that was going to happen. Okay, so that's so those are those two. I consider these ending diagonals to be corrective waves because they look like they're corrective, and they also tell you that the trend is going to change as soon as they're done. All right, and that's one of the keys to ending diagonals. All right, I'm going to just talk about the two kinds of waves. So we have motive waves, and I thought this was a great analogy here. You have a nice copper penny that looks brand new, and motive waves keep to their Fibonacci lengths. So a first wave will always retrace to 62% at least. It may go a little further than that. And the fourth wave will always retrace to 38% all the time. And the third wave always hits either 1.618 or 2.618 in terms of its length compared to the first wave. Everything just works like clockwork. You can kind of dial in your trades. In a corrective market, it's like having a black sheep in the family. It's still your brother, and you know they do the things kind of normally, but every once in a while they do some strange things, and it's maybe not at the right time. And some of the concepts are similar, but they don't work as well. And that is the corrective environment that we're in. So I don't like corrective waves. We happen to be in a great big fourth wave right now and have been since 2018. And they're very difficult to trade, very difficult to analyze, because Fibonacci numbers, you can have several different places that they can hit, like, and that gets into the corrective wave part of it. So they're just difficult, and you don't know how long the pattern's going to go for. So I just wanted to sort of bring up that analogy. And I'm going to go through these relatively quickly so I can show you some examples of things coming up. So here's looking at that same motive wave to the upside. And I just want to show you where these things, I talked about ending diagonals and flats. So you always get corrective waves in the second and fourth waves, all right? You either get, and I mentioned this earlier in earlier notes, you can have, in a fourth wave, you can have a flat, a triangle, or a zigzag. You could also, I'm not going to go there. And it can be a combination as well, which we have that wave down. I would still call it a combination. The wave down we had from February in the S&P 500 was a double zigzag. So that's two zigzags together. You can have up to three of them, but I would still call two zigzags a double pattern. All right. You could also have, if we only had one zigzag, we also could have had a triangle, and that could have been part of the fourth wave. So you find that you can have three different patterns are the max in a combination wave, and that's typically in a fourth wave. You can also have it in a second wave, but second waves tend to be either a flat, which is a three-wave corrective pattern, or a zigzag, and the same thing. You never have a triangle. I think I've seen one once, but it was as part of a combination. There was a zigzag and then a triangle at the end, a very large wave. But if you've got a triangle, something's wrong with your second wave, okay? There's certain things you can learn about Elliott Wave going on. Elliott ending diagonals happen at the top of the third or the top of the fifth. Rarely the top of the third, but we've been getting a few of them lately. And top of the fifth, they're rare, but that's where you're going to get them. And also a C wave. So if you had an A, B, C wave, you can get them in the C wave, either the entire C wave or as the little fifth wave of the C wave, the end of the C wave. So there's two places you're going to see those. I should also mention the rule of alternation. If you have a very sharp wave here for the second wave, then the fourth wave is typically going to be more sideways. All right, it'll still hit its 38%, but it isn't going to be a really sharp zigzag, for example. So typically, if you have a zigzag here, you're not going to have a zigzag here in the fourth wave. It's going to be a different pattern. And think about it that way. All right. So that's one thing that I thought I would just mention. So moving on. So here's corrective zigzags. This is the most common correction in the market. And you find this all over the place. Now, here's where I want to mention something that the Elliott Wave Principle does not explain. In fact, it's an error in the book. I've shown you a 5-wave motive wave, and that can either be in a bear market or a bull market. This wave is also 5 waves as the zigzag. I call these simple fives. They do not follow the motive wave pattern. Okay, you will often find that the first wave of the zigzag is in 3 waves. You can also find that the 5th wave is in 3 waves. Generally, this third wave tends to be in 5 waves in a zigzag, but they can have very strange looks to them. So you can also, like you could have, oh, I've got some down here, 1, 2, 3, 4, 5, and a great big one here. That's a more regular looking one. This is a little more common, and you could have even a 3-waver off the top or a very small little second that you can hardly see, and you would still call this a zigzag. If you can find 5 waves within them, but the 5 waves will not have lengths that work normally like a motive wave, I call them simple fives. Here's another one. I mean, I could still call that a zigzag. It would have a little tiny 4th wave down in here and another one with 5 waves. And they always have 3 waves in between. And that's a zigzag. Now you can have 3 of these, up to 3 of these in a row. And so you'd have another B wave and then another zigzag and another B wave and then another zigzag. All right. And that's like an ABC within that. So we had one in 2018 in the S&P 500, the big wave that came down from the top of the 3rd wave right at the top in January 2018. Bear market going the other way. Not much more to tell you. I'm not going to go into the rules of these other than just to kind of point them out to you in terms of what they are. There are 3 kinds of flats. There is a regular flat, an expanded flat, and a running flat. And they're all basically the same. The only difference is kind of where these things end up. So you start with an A wave in 3 waves. Then you find a B wave in 3 waves. Now this is a regular flat, which always comes up to the top and hits the top of the A wave. Like this is the A wave here, but it's the beginning of it. And so it creates just kind of a horizontal line there with the double top. And after you see that, you can expect a C wave down in 5 waves. All right. And that C wave will typically go to a new low. And usually it is 1.61, anywhere up to 165% of the length of your A wave. All right. There are other stipulations in it. But the thing that the book has wrong is they call this wave an impulsive wave. It is not. And in fact, the 5th wave very often only does 3 waves. All right. And that can really throw you off if you're expecting 5 and all of a sudden it heads up on you. And once it gets to the area of the first wave, you know that it's done. Okay, because then you know you have a correction, because once the 4th wave is in the area of the first, you know, oh, okay, we're done. It's corrected. It's gone into the area of the 4th wave. This is no longer a motive wave. All right, so that's one of the keys. So there's little things you learn, but you can have, usually the first wave is in 5, but it can be. I call it a simple 5, but just much larger. And that's one of the things you learn as you go. This is it in the opposite direction. So that's your regular flat. And the expanded flat is simply the same thing. This is the beginning of the A wave, but the B wave goes up higher than the top of the A wave. That's the only difference between an expanded flat. It's the same pattern. 3 waves, 3 waves, 5 waves, 3 waves, 3 waves, 5 waves to the downside, okay? And the 5 waves are your C wave. And there it is in the opposite direction, okay? You find these in 2nd waves and in 4th waves. and they can be part of a combination wave and a fourth wave, not typically in a second wave. And this is a running flat, and the only difference with this one is it's like an expanded flat. It goes to a new high here, but the wave that you get for the C wave doesn't come down to a new low, and that's called a running flat. But it's the same pattern. There's no difference to it. It's just the length of the C wave in this one doesn't go as far. And we had one of these in 2018 as well, at one of the tops. It didn't come down very far. And there it is in the opposite direction. Okay, triangles. There are 4 triangles. One of them I do not think is correct, but I'm going to go through each of these quite quickly. Triangles have 5 waves. Each of the waves are in 3 waves. So you mark them like this: A, B, C, D, E. And triangles are continuation patterns, so they'll go in one end and come out the opposite. Okay, so you can always count on that. And this is what they look like. Now, I see people drawing triangles that, you know, you'll get them doing these sorts of things where you have this great big thing, or you know, these patterns where the triangle kind of looks like that. And that's not a triangle. The triangle has to go horizontally and has to have a symmetry to it. Okay, so that is a contracting triangle. There's only really 3 that you have to worry about, 3 key ones. But this is the one that you see 90% of the time is a contracting triangle. So it has to go sideways like that, or it is just not one. All right. And the third wave is typically the most complex and can take the longest. And if it isn't, then the D wave takes over that job and becomes the largest. So if you get a very large C wave that seems to go on forever, that is one of the ways you know it's a contracting triangle, and you know which wave you're in. It is typically, you find them in 4th waves, and this would be the bottom of the 4th wave. And then you would have the A wave here and a B wave, and then this finally goes up to a final high. So triangles, when you see them in the 4th wave position, tell you that there's one more wave to go to a new high, and then you're going to have a trend change. All right, so they're kind of like ending diagonals in that sense. And this is one in the opposite direction. All the waves within them are in 3s. Okay, so they have to be ABCs. Now that will be pretty obvious to you. Corrective. Now, a barrier triangle, these are very rare, but the only difference in these is that they have a horizontal line on one side, and that is the continuation side. So it always goes through when they're done, goes through the barrier. And so, you know, you don't see them very often. But all the waves are in them are in 3 ways. And the last one that is key that you will see is a running triangle. These you can't trade. Unless you found one that's really big, but they tend to be buried in near where a 4th wave would be, and it's almost a continuation pattern. So you tend to have waves that, you know, are kind of, how is it? Like that kind of, and if you don't see it coming, I mean, you can miss them very easily. They're these little continuation patterns in a wave, and they're good to see because it tells you where you are, but you never end up being able to trade them. They're just too difficult to see, and they really do move on an angle. This doesn't really show that much, but they move with the trend and not against them. So I just want to show you that. But their pattern's the same. You'll see all the waves will have 3. There should be 5 waves. I see people also calling these running triangles where they don't always have all the waves in them. The other thing is that sometimes the E wave on these will be short and won't make it down to the trend line. So they're just really difficult patterns to see and trade. You know, I wouldn't pay any attention to, but they will tell you that you have a 4th wave, and it gives you an idea where in the wave pattern you are. That's the only real reason I use them. And here's an expanding triangle. Now, I've never seen one of these. I am of the opinion that this is more like a broadening top, and that's the way I use it. So when you see one of these, and I haven't changed this diagram, this is kind of comes out of the Proctor book, and I'm really trying to figure out how I'm going to handle this in my book. But the way I see these is that they do not go through here and come out the other end. These, to me, are ending patterns where you will have a final wave up here and then it will head down from there. And they end up being like what did I just say? A broadening top, which is really what we have in the U.S. indices right now in the S&P 500. All right. So just wanted to, so this one, I've really never seen one like this that's gone through like that. I don't know. I think it's an ending pattern, so I'm still grasping that one and trying how I'm going to treat it in my book. But that's the fourth triangle that you don't see very often. Here's the combination waves. You'll find these in fourth waves. I'm showing these going sideways, but they, in a bear market, they'll go that way. In a bull market, they'll go that way. So you can have, for example, here is a flat. You can see that. Sorry, that's not the flat. It's leading into it. Here's the flat. 3. Do that a little better. 3, 3, and then 5. So there's a flat. Then that can go into a zigzag, or the opposite. There's a zigzag, an ABC. There's another zigzag, and here is a triangle. Triangles are always the final pattern within a combination. Okay, if you're going to get one, it's going to be the last one. Same thing with an ending diagonal. You can also have an ending diagonal, as they're very rare, but you can have them. Actually, we got one. Oh, they can be at the end of zigzags too, because we had an ending diagonal in the big wave that came down from February. When it landed at the bottom, we actually had an ending diagonal right at the bottom of that. And we also had within that, that was at the bottom of the C wave. So that made sense. But you can also have, as part of your combinations, an ending diagonal as well, not shown here. And so here it's just showing it as another little configuration, as different zigzags and things. So you can have up to 3 patterns in a fourth wave. You can't have any more than that. All right, so that is an interesting thing. And then very large ways you have them. So here is a little change in trend thingy that I did up, and I should probably mention that this is the fourth wave and this is the fifth wave. So this just reinforces the point that I'm making about when you have the end of a trend, a bull run, what you want to do is you want to wait for 5 waves down, preferably past the previous fourth. And that tells you you have a first wave, or you have very likely, the probability is that you have a first wave in place. Then you wait for a 3-wave retrace to 62%. And that's where you want to get in short in this case. Okay, that's your trend change. So it keeps you away from trying to trade tops, and Kyle, and and others that get into things and just kind of wait them out. There is always a first and second wave in a new trend change. So you can always find this and get in there and save yourself the pain of being in this thing that you think is ending and it keeps on going. Because once you see 5 waves down past the previous fourth, that's telling you the trend is changing. And once you see the 3 waves up and it turns down, then that is confirming it, and you have a new trend. All right. So I just want to, it's really important. A lot of people don't pay attention to this, and people, I don't know, certainly in the free blog that I put, write notes and things, and, saying, well, would you call the top there and stuff? And it's like, I don't really care where the top is in a way. I want to get the top of the second wave. And then, I don't have to trade that often. If you get a really good third wave and a fourth and a fifth down here, you'll make all you need to make for a year. So it's just finding these opportunities. That's called an Elliott Wave setup. There's other setups and patterns once you know the pattern that you're in. But again, once you know where you are in the mode of wave, and whether you're in a second wave or a fourth wave, you can generally be looking for patterns, and you get a good idea of where you're going in terms of corrective waves. What else do I have here? All right, here's a little test, and you can tell me what you think of this wave down. I just thought I would pull up some waves here. Is this a corrective wave from here to here, or is it a motive wave? Put in your votes, and let's just see how you do here in terms of tell me what that is, and I'll just then show you the way that I labeled it once it was done. I've cleaned these off for you so you can get an idea. I've got 3 of these in a row that just give you an idea of wave patterns and just sharpen you up. But you have to get used to these and knowing what is a corrective wave and what is a motive wave. And over time, you get very much better at it. So anybody want to tell me that? Sorry, I had these as polls, and unfortunately the polls all got taken away from me when Deb votes corrective. Be careful, Deb's beside me. Okay. Deb, okay, corrective. Derek, corrective. So we've got some correctives. Anybody else? I know Carlos seems to know what he's doing here. And Bart, fourth in an area of first. Okay, I'm not seeing that. So you're saying that it would be motive, but it's a motive wave that has become corrective. Looks corrective. Okay, it's corrective. So going on to the way I would number this. So this was actually the top of a third wave up here, and this is the bottom of a fourth wave. So it's actually, there's a little A, B, C down in here that you can see. So, you know, you kind of squint your eyes and you look at this and you go, well, that is a 3. All right. And that's the way you can look at it. Now, this was a 5. You can see that here if you look at it carefully. 1, 2, 1, 2, 3, 4, 5. And that meant there was probably going to be another wave following it. All right. And then we got this correction, and then we got another wave down, which actually looks like 5 waves. But, and I think I have a better one to show you on this, but it actually had a 5th wave down, or sorry, a 7th wave. It had 5 waves down and looked great. 1, 2, 3, 4, 5, right to there. And then it had another wave down, which made this corrective. So this wave is corrective. It didn't need to be. This could be 2 5s. This could have been a 5 down here, and a 5 down here would have made it a zigzag. But this is clearly corrective the way it was. And this ended up giving us a wave up in a 5th wave. So I saw that, and I think that was one that I called. Let's go look at another one. Oh, this is the continuation. So this just shows you the same thing wider. So we had our ABC down, and then it did a 1, 2, 3, 4, 5. So it not quite complete at the end there, but so that just shows you when you see a corrective wave, you know it's going to get completely retraced. And so you can be looking for a first wave up. And once you get a first wave up that looks kind of like that, like straight up, and you get a correction down in a second wave, you enter down here and you know you're going to get a third wave. All right. So, and you can actually play the 4th and the 5th up to a new high. So that's the key, is looking for these, you know, not necessarily playing the corrective waves, but knowing when you have a corrective wave. And you could then measure this. This would probably be, I don't think it was a 1.618 Fibonacci correction, or extension rather, down to the bottom here, and then you can pick the bottom. And but the key thing, could pick the bottom here, but the key thing really is to look for a first wave and then a second wave. And the second wave was in 3 waves. Hard to see on this chart, but it is there in 3 waves. And then we got a third wave up, and this is the 4th wave in 3, and then 5 waves. So that's kind of how you use it. Here's one. Okay, is there a pattern here? Anybody see a pattern here, and what is it, if there is one? Anywhere in the wave. Just tell me what the pattern is, and I'll go yay or nay. So you're dealing with this kind of stuff all the time on this. This is an interesting one, and this one happened very recently in the Australian dollar. Bingo, Bart got it. So this is a contracting triangle right here. So you can you get used to seeing these things. And in fact, I have a chart showing this. So there's your contracting triangle, where it's actually this one is a bearish triangle, and it has got a problem being a bearish triangle, but an A, B, C, D, and an E should have come down. But when you find these types of things in this position, when you think you've got a first wave down, actually, this can't be a first wave down, but this one actually ended up going back up to the top. So the triangle broke on the upside. And once it breaks on the upside, and it's a bearish triangle like this, if the A starts here on the upside, it's a bearish triangle. If the A starts on the downside, it ends up being a bullish triangle. So it's a case of where the triangle really starts. But this has gone up to a new high, which I kind of figured it would. But I thought it would be a good one to show you, because if you can pick out the triangle, that's a good deal. You're way further ahead. This one, is this wave down on the left corrective or impulsive? Good, Mark, you got it too. Ending diagonal converging. Nope. Sorry, Carlos, not on that one. I'm not going to trick you with one of those today. This one's a little tricky, I will warn you. So you're just looking at this wave from the top to the bottom. Is it 5 motive waves or not? Or is it something else? Because if it's something else, it's corrective. Okay, thinking about that one. I don't blame you. It's a tough one. Okay, I'm going to tell you what I saw on this, and if somebody got it, good for you, because these are corrective mess. Well, it's not a mess, Derek, but it is corrective. You're right. Actually, it was an interesting wave because it came down in 5 waves, 3, 4, 5, and I can actually see 5 waves here. Okay, so it looked perfect, and then all of a sudden it screwed it up by coming down to a new low. So you end up having to call this 5 waves with a B and a C, so it's a corrective wave. So it's an ABC. A lot of times you will get an AB C wave like that, but you will find in the C wave that there are 5 waves. And this is something you see all the time. So you have to be very careful. If you can find 5 waves and you have another wave, ends up being a corrective wave. It ends up being an A, B, C, with the C wave having 5 waves. It's corrective. And this is the opposite of it, where you had a great looking impulsive wave, and then it screwed it up by coming down here and making the whole thing corrective. So, and this is obviously corrective because it's a corrective mess. So you see these a lot of times when you think you're changing trend or something, and the wave comes down and you're waiting for a second wave, and it just turns around and goes, or it goes down even further, goes up a little bit and comes down further, goes up a little bit and comes down further, or it will just go right through the roof like this one, because when you have a corrective wave, it always retraces right up to the top. And so that's what you're seeing with this one. All right, just because it ended up being corrective at the bottom. All right, so here are some things quickly that you do not want to do, and I won't mention any names of the company that this individual who wrote the book works at, but I just see stuff coming out of this group and other people that I just shake my head and go, what on earth are these people thinking? So here is a what not to do. This is the top, and you get this wave down that looks kind of like this. All right. And they're calling this impulsive because you can see that it's got a 1, 2, 3, 4, 5. But is it impulsive? No, it is not impulsive, because you've got a great big second wave here. And then your fourth wave, they've got it just buried down in here. It's just, there's their little fourth wave. You can hardly see it. So the fourth wave, in order for this to be impulsive, the other problem is that the third wave here is kind of short. but the fourth wave would have needed to come out like that. All right. And so you have a nice impulsive wave, but it did not. So I often see these cascading waves like that where people think that they're actually an impulsive wave, and they are not. You get a great big second wave, and then you get this little corrective thing, which is actually 5 waves. If you'd counted this correctly, you would have found 5 waves within it. And so this becomes an ABC. So don't do that. And then they're calling for a second wave here, which they think they're going to get, but it's going to go right back up to the top and screw them up. So, you know, there you get that. I see that all the time. Here is another one. This is a little more difficult to see. Well, actually not in this, but they're also calling this an impulsive set of waves. I don't know why. They've got, look at this. They've got this kind of strange looking thing here. You look at that and you have to go, if you squint your eyes, you go, what, is that impulsive? It's a 3. But they have put a first wave right here. Now they've got a second wave up here. And then their third wave is actually down here, but it's actually this wave right there. And a little tiny fourth and a little tiny fifth. and here they've got the first wave coming down to a first, and then they've got an A, B. Well, I see this on these guys. They do it all the time. They put an ABC wave in the middle of what they think is an impulsive wave. You can't do that. It just breaks every rule in the book. And yet they do it again and again and again. This is a 3-wave corrective wave. It is not an impulsive wave. So when you see, and I've got another one similar to that coming up, but they tend to put these little ABCs. So if you're looking at an analyst and you want to determine whether they actually know what they're talking about, if they are doing these sorts of things where they're putting, if it's not a second wave or a fourth wave that you're doing an ABC in, then it's incorrect. You can't put it as part of a first wave. It just makes no sense. The first wave has to be there, and then you have a second wave. So, you know, I see this all the time. Here's another one. This is from the bottom of 2009, which was right there. And this wave, they did the same thing where they've got a first wave up, and then they've got an ABC to the second wave. Well, you can't do that. Your first wave needs to be an ABC directly down. That would be your second wave. But and again, I see this all the time, and it's absolutely incorrect. You cannot do it. And so then their count is off. And in fact, they have this. One of the reasons they think this is a 5th wave is because the screwy wave, the way that they are labeling it, and it's actually a B wave, and I'm going to get into that next. So here is looking at, and this is about as big as I can make it, unfortunately, but this is looking at the wave structure from 2009 down here. Oh, I need to change my color again. Let's make it a nice white so you can see it. So down here is 2009. And what I just showed you in the previous slide was this wave up here, which I'm calling a first wave, okay? This wave is the one that they did the first wave and then an ABC to the second wave. So they call this a 1-2, which you can't do. But even if they did that, you would say, well, that's ridiculous. This thing would then be corrective. But this wave here is actually a zigzag. And it's hard to show you this on this particular chart because it needs to be bigger. But you have a little 1-2. Now the second wave came down about 23%. And I'm not even sure it made it that far. 62% would have been down here. That is a red flag that says you do not have an unfolding motive wave. You have something that's corrective. And in fact, you know, and one of the things that Prechter said when he talked about unorthodox tops is you cannot have a B wave anywhere in the market at a top. Well, this is the top of the 5th wave in 2007. And sure enough, we have a B wave. And I call this an unnatural wave because it's all the debt that the central bankers put into the market. It shouldn't actually be there because 2007 was actually the cycle top. when you get into cycles. And then we have this very unnatural corrective wave to the upside. And that's why this is so bloody difficult to trade, because the whole thing is corrective. Now, Fibonacci still works, because you can get accurate Fibonacci readings from measuring this wave as a first wave. And in fact, this up here, this line that I'm showing you at the top, is actually the 2.618 extension of this first wave. So it tells me my eventual top is probably going to be at about, the number there is 3642. So a little bit above 3600. But we're not done yet, because I've got us at the top of a third wave, and we need to do a fourth wave and a fifth wave, and then the whole market is going to collapse. So you have to look at the wave structure on this, and that's one of the other reasons they've got this wrong, is that this is a first wave and a second wave, blue, and then we have 5 waves up in the third wave to here, that is the, yeah. And then we need a fourth wave for that, which we're going to get, because this is the top of the third we're at right now, a fourth wave and a fifth. So you can see that we've got these yellow ones, 1, 2, 3, 4, 5. We've just completed the fifth wave up. Now, I thought we were going to get a fourth wave down that was going to give us this leg and then another one. And we didn't get that. So I was wrong thinking that. But this is a wave up that is, and the reason it's never ending, because it tends to be a third wave of the third. All right. So you're seeing a 1, 2, 3, 4, 5. And all of these waves measure correctly from a Fibonacci perspective. This is the fourth wave of the third, and there's the third. And then you have a fourth wave and a fifth wave of the third, of this big blue third. All right, so now we have a big blue fourth to do. So that's why I can tell you that this top we're seeing, that we're waiting for, is going to give us a great big wave down to a new low. And then we're going to have one more final wave up in 5 waves to a final high. So that's how you can use Fibonacci. But you have to be, this is just a whole comment on, it really is a science, but man, doing this took me years to learn. And you're not going to be able to probably have this kind of detail. But if you understand Fibonacci, if I explain, or sorry, Elliott Wave, if I explain this to you, you can make the decision as to whether I'm full of crap or not. And you will know whether to follow me or not. And I think that's one of the important things. And also telling you about what the mood is and where waves are going to end. And those types of things are the things that you can get really good at in Elliott Wave. But actually analyzing this is a toughie. And, I really had to work hard at this and look at it and do a lot of measuring to get this. And so if you want to become an analyst full time, go for it. But it's going to take you a long time. It's going to take you several years probably to feel super comfortable with Elliott Wave and be able to analyze with it and make real good money with it. But there are certain things you can learn. And one of the things you can do, if you master the second wave, for example, you can make money on first and second wave combinations and do it that way. And, you're going to have to wait for them, but you can look around the market and find them. So that is kind of the way that I look at Elliott Wave. And I'm going to finish up here. Yeah, I thought this would be close to an hour and a half, but we're pretty well done. And take any additional questions that you might have. But Elliott Wave is, as far as I'm concerned, a really complicated science. And I turned that to white, didn't I? That was a dumb thing to do. So turn it to white. Complicated science, and really the analyst is the key, because I've never found Elliott Wave not to work. If it doesn't work, it's because I'm being particularly stupid and I miss something. And that can happen. And so one of the things I tell people, I get a lot of people that are telling me things about ES, for example, which is the futures, or the S&P 500. And have you looked at any of the other indices? You have to look at other indices and know what they're doing in order to know what the S&P 500 is doing. You have to look at the New York Stock Exchange to know whether you're at a new high and whether that is going to affect everything else or not, and whether this is a corrective wave or not. The whole pattern up from 2009 is corrective. So we're in a corrective environment. And while that wave looks like a 5 to a lot of people, it really isn't a 5. And the NYSE has got a corrective wave up. There's no question about it. And it's not at a new high. So that tells you that, somebody asked me the other day, could the market be at a final top? Well, no, it can't, because the New York Stock Exchange is not at a final top. So you'd have to have everything at a final top in order for the entire market to come down and be at a final top. All right, so mathematical representation of the herd. I keep clicking on the wrong thing here. That's what I look at. It tells you about the mood of society and the herd and what's going on. Market position determines events, not the reverse. So people tend to do something when they're when the market is at a high that they wouldn't do when the market's at a low, because they are very positive about things at a high and not that positive at a low. The other thing is that I should mention, I mentioned to you, 2007 was the cycle high. And everything turned negative, but the central bankers threw a whole bunch of money at the market. And that's why we have this wave. Oh, now I'm black, you see. So I got to go back, Kyle, to your favorite color. So that's why that didn't work. That's why we have this great big wave up that's a B wave. But, 2007, society started to turn negative in terms of their thinking. It didn't matter what the central bankers did. So now all of a sudden things are coming down and everybody's turning super negative because the negativity was already there. So it's kind of fascinating things like that I look at, because this is a rogue wave, this whole thing up, and it's going to come down real hard. And we're going down eventually in the Dow, for example, to 3,000 once this thing craters. But it'll top sometime next year. So I just thought I would point that out. That's another way you can sort of use the mood thing. Trends are in 5 waves, 3 waves retrace. Trends are in all through society. If you have a business, you can also follow the trend of your business based on your sales, because it will move in 5 waves. And so once it starts to wane in the 5th wave, then it's just like the market, just because businesses do that. And now we're seeing a whole bunch of businesses wane as the market is topping and a lot of them going bankrupt. Fibonacci runs throughout the market, identifying patterns and being able to see them. And it's critical that you can tell a corrective wave from a motive wave. All right. And that takes time. And either you have a capacity for being able to do it or you don't. It took me a long time to figure it out. And then I would always go back when I was wrong and figure out why I was wrong. And then I just got better and better at it, because once you figure that out, then you know what you did wrong and you catch it the next time. And it's predictive based on knowing what your options are. So that's critical, because it's really not predictive on its own. And a lot of people say that, and they're correct. But if I know that we're approaching a 4th wave and that I'm going to have one of several patterns, and I can tell the pattern going in really quickly, if I can see it's a zigzag right off the bat, then I know how to trade it. If I know it's a triangle, then I know how to trade it. But, that's the thing. And then when it gets to 38% and a retrace on a 4th wave, that it's going to turn in the other direction pretty soon. So it's those sorts of things that make Elliott Wave predictive. All right, so I'm going to take any questions that I can here, and thank you for hanging in for the length of this. It's a complicated science, and it just takes a while to explain, and then you always get tons of questions. So Carlos, please explain your 3rd bullet point. How does a geopolitical event not change the market? Well, Brexit, for example, when we had Brexit, the market came down in 3 waves. And everybody told me, I was on a plane. I remember that very distinctly. So I got back the next morning. Everybody told me that was the top and the market was coming down. I said, no, it came down in 3 waves. It's going right back up. Sure enough, it went right back up. And that's an example for you. You can go back. I've written blog posts, for example, on 9/11, which was in the middle of a downturn. And it just kept going. It didn't really change anything. It was 9/11 just continued the downturn, but it was about, as I remember, about 2/3 of the way through the downturn. So, it didn't change anything. So, but Brexit was probably the key one. You can go back. I've done blog posts showing the crisis, the John F. Kennedy crisis, and various things. And, you get a reaction for a day, and then that's about it. And it just then turns up and follows the event. Philip, good. You go, and everybody will get a copy of this, of course, probably within the next hour, and you can review that. Is there any other question? I hope that answered your question, Carlos, but there's lots of examples of that. Events the problem is you get all these pundits talking about the market did this or the market did that because of such and such a thing. And then when it does something the next day that's the complete reverse, you see them scrambling around trying to come up with a reason that it did what it was not supposed to do. It's just amazing. Okay, world event can influence the timing of the next move. Well, they can, but if for example, you get a Brexit and it came down in 3 waves, I wasn't able to trade it because I was still on a plane at that particular time, but that it's going to go right back up again because 3 waves retraced. I mean, that's the way that I use it. All right, so there you go. Any other questions? I'll handle any of those, and then we'll let everybody go. And you will have access to this as much as you want. This is something I'm going to put on my site so that anybody can run at any time they want to get a better understanding of Elliott Wave, because I'll tell you, there's a lot of skepticism, and the skepticism comes from people like the big guys who really don't understand how this thing works. Like, for example, in the book, you will find in Prechter's book, leading diagonals. They don't exist. Nobody's ever seen one. He added that to Elliott's work, and it's just wrong. The other thing is truncations. Elliott was in the very early stages. Prechter said truncations are real, but all of the charts that he uses to back that up, I've gone in and found they're in the middle of waves. They're not truncations. There's never, and how can you, and he believes this is a science as well. How can you have a science that fails every once in a while? That makes no sense. So there are no truncations. I've never been able to find one. I have looked and looked and looked, and I've looked at all the examples, and they're not truncations. So there's another one, and there are a number of them in the book. The other one is the simple fives, is that anytime he tells you in a correction that it's an impulsive wave as a 5, like in a flat, it is not an impulsive wave. It has problems, and it doesn't fit the 5 waves in the first wave and the 5 waves in the 5th wave, but it will have 5 waves. So it's those things you need to understand. So Mark, you say we are in a B wave since 2009 lows. What is the rule on how high a B wave can go past the top? Past the top of what? Oh, there is no rule. Top of the market, there is no rule really, except you get into, the rule would be your first wave. Once you have the first wave in place, then you can extrapolate from that by doing a Fibonacci measurement. So that's what I was doing when I said that, this is probably going up right to that level. It's actually a 4.236 extension. Which is 2 times 2.618, and that's measured off this first wave. But the problem is, it also could have ended here at a 2.618. That's the problem with corrective waves, is you can have various places it can end, but it will end on a Fibonacci ratio level. And it will either be 1.618, 2.618, or 4.236 on a great big huge wave. All right, but in terms of the relationship here, there isn't really one. And if you go back and you look at this wave in 2008, you will find that it is in 3 waves. This is one where it had an A, B, and then a C. And if you look at this carefully, you'll find that there's a 1, 2, 3, 4, 5. So the C wave had 3 waves, and it measured to be 2.618, the length of the A wave. Bingo, it's a corrective wave. So that, and what happened is the 5th wave wasn't large enough, because they started talking about doing QE. They put QE in right about there, and it actually changed the wave and made the whole thing corrective. And I didn't see this till much later, but we expected this to go up 62% and then come down, and it didn't. And if I had known this earlier on, but I wasn't really doing my own thing until about here, where I got really fed up with the other guys, and decided I was going to learn this if it killed me, and it almost did. Made me old. Okay, Leon, how will you know when current wave has topped? Oh, well, we're topping right now. And if you were in my service, you would know I put on a chart of the West Texas Intermediate Oil today, which has gone sideways for like, I don't know how long. And I said, this is my frustration level. It's just right up there. We're at a point now, and I can't show you the charts, but well, in actual fact, we had one of these charts I actually showed. Where was it? Somewhere down in here where I showed a motive wave. Yeah, this is the latest wave up. So this is the fifth wave. This is the final fourth, final third, and this is the final fifth wave, fifth of the fifth. Once you get to the fifth of the fifth, and now we have a full count here, we're waiting for this thing to come down. And I'll just be very, very short on this. One of the things that's happening and has been happening for the last 3 or 4 years, and Prechter came up with this, he said it's going to be all the same market when we're near a top. And sure enough, I caught it about 3 years ago and said, okay, everything's starting to move in tandem. Everything is going to top at the same time. So I covered DAX. It's at a top. That's the German exchange. All of the currency pairs, the dollar looks like it's almost bottomed. I think it probably has bottomed, but I'm not 100% sure of that. But it looks like it's bottomed. And all of the currency pairs are topping at the same time. We just have a little bit more work to do. It looks like right here we're going into a little tiny triangle. And so this could take a few more, it could be tomorrow, it could take a few more days. But that's how I will know. And you will know once you say, because this is what I drill into everybody, this is your first fourth wave. So once we have a top, you'll have 5 waves down, and then you will have 3 waves up to 62%. That's a market top. Boom. And that's where you get in. So, you can play this game of trying to catch a top, or you can just simply wait around to get that 5 waves down and 3 waves up, and that tells you that the market has topped. What are you missing? 25% here at the top. Very little in your trade, and you got a lot less risk, and you get the whole, because this is going to go down about 1,500 points. I mean, this is going to be a big wave. And the first one came down, the previous fourth wave came down in a month. So we're probably going to get this coming down in a month too. It's going to be very fast. And everything was going to be moving in tandem. I think gold and silver are probably also going to come down with it. The whole freaking thing is just going to come down in the next few days, starting. And because we're at a top in everything now. So that's how I'm going to know. Okay, I think that pretty well wraps it up. We're getting a little long in the tooth here. I hope that made sense to you. But that's how I would know. It's really waiting for those 5 waves down and the second wave up. That's what we do in Elliott Wave. And once you know you got it, you got a trend change. Once you're down below this previous fourth. Okay, so I'll just add one more thing. It'd be 5 waves down, second wave up. Once you're below that in what's in a motive wave, then you call it top. Okay. Once you're down below this fourth wave. But you need to the first wave needs to come down just below the fourth wave to be a first wave. Then you get a second wave. Anyway, that's it. Thank you everybody for being here. You should see a video shortly. And if you have any more questions, as long as they're not biggies, and don't go on and on, I'll let you have one question. You can email me at peter@worldcyclesinstitute.com. and I will respond to that, peter@worldcyclesinstitute.com. Just one question. I missed talking to you, or you had something you wanted to ask and you didn't know what it was, but it occurs to you on rewatching this. And you'll get the video coming to you, and it'll be and now the other thing I will say to you, that the video you're going to get will let you watch this but not stop and start. So if you want a link to the YouTube video, but I'm going to put this on my site as well, and I will have that probably it'll be in the free blog area. If you know where the market report is, my free blog, I'm going to put a link there, and that will be to the YouTube video, and that will be up by tomorrow. So you can find that there tomorrow, and that will also give you the YouTube link, and that will let you go backwards and forwards, okay, to and stop and start and that sort of thing. Okay, I'm out of here, it's been a long day, and thank you very much and some great questions. So thank you very much, because it lets me know what people are interested in and what they're challenged with in terms of Elliott Wave, because I have been doing this a long time, and you kind of forget the things that perplexed you a lot in the very beginning. And that's it. I will leave you now, and thanks again.